Let's jump right in. Welcome to today's explainer. I am super excited you're here because for the next 8 minutes or so, we are going to decode one of the absolute most notoriously confusing candlestick setups in all of technical analysis, the hammer and inverted hammer clash. You probably spent hours studying single candlestick patterns, right? You feel pretty confident reading market direction, but what happens when the market throws two totally contradictory signals at you, literally back to back? It's the kind of thing that makes you want to chuck your monitor straight out the window. Well, today we are breaking down the exact mechanics of this clash. Let's get into it.
So, picture this. Put yourself in the shoes of a live trader for a second. You're staring at your screen. The market's been in this grinding downtrend. Suddenly, boom, a hammer forms. Textbook theory practically screams that the market is going up. But wait, the very next candle forms and it's an inverted hammer, screaming the exact opposite. The market is going down. Sweaty palms, right? Hammer equals up, inverted hammer equals down, and they are staring right at each other. What on earth do you do? Honestly, this exact scenario is where normal retail traders just freeze, second-guess their entire strategy, panic, and ultimately lose money.
Look, on the left side we have our classic hammer candle. When this pops up after a downtrend, it tells us buyers have aggressively stepped in and we expect the price to rise. But on the flip side, we have the inverted hammer. This tells us sellers just fiercely took control and the price is going to fall. The contradiction here is massive. You've probably watched dozens of tutorials explaining these two candles in isolation, treating them like totally separate events. But when they form sequentially, first the hammer, then the inverted hammer, you're left with a completely new dynamic that textbook theory rarely prepares you for. It's literally like two opposing armies suddenly crashing into each other on the front lines.
Which brings us to Section 1, the battlefield breakdown, buyers versus sellers.
Okay, let's view this price chart as a literal battlefield. Follow the timeline with me here. At point 1, the sellers are in total control, pushing the market down in a clear, brutal downtrend. Then, at point 2, the buyers mount this massive counterattack. They pour into the market, take over, and form that hammer candle. They are essentially planting their flag and saying, "We are taking this market up." But here's the twist. At point 3, as the price pushes higher into seller territory, the sellers violently reject them. They smash the price all the way back down to exactly where it started, forming the inverted hammer. The sellers just proved that this is still their turf, completely wiping out all the effort the buyers just put in.
So, what does this all mean? Well, it introduces a concept called the winner candle. This is simply the most recent candlestick in a sequence that successfully overtakes the previous candle's sentiment. It's the candle that dictates the true market direction. In our clash, that initial hammer candle, it's the loser. The buyers tried so hard, but they failed. The inverted hammer, representing the sellers who successfully defended their zone and crushed the buyer's momentum, is the undeniable winner here.
Moving on to Section 2, the rule of the winner and how it dictates market bias.
I actually love the analogy from our source material for this. It says, the market only listens to the winner, just like an election. Think about a major political election. When a new leader wins and takes power, the influence of the previous leader instantly fades away. The public, the laws, the momentum, they all follow the current victor. The market operates on that exact same logic. It genuinely does not care about the loser candle. It doesn't care who held power 5 minutes ago. It only respects the power, the presence, and the dominance of the winner that just took control. Because of that, you've got to engrave this rule into your trading strategy: follow the nearest candle. Since the market always obeys the most recently formed sentiment, our bias in this specific hammer followed by inverted hammer scenario has to immediately shift to the sell side. The inverted hammer is our newly elected leader. The sellers are the absolute victors. Therefore, we are absolutely not looking for buying opportunities here. Actually, scratch that, we are only looking to sell.
Let's jump to Section 3, avoiding the retail trap and trading like smart money.
Now here is where the absolute most dangerous trap lies. Look at the retail trap on the left. What often happens is, right after that inverted hammer forms, the market creates a fake, highly volatile upward breakout. Uninformed retail traders see this upward blip, they desperately remember that first hammer, and they just impulsively buy in. They are walking right into a massive trap, guys, because the sellers are actually just reloading their ammo for the next leg down. When the price inevitably crashes back down in favor of the sellers, those retail buyers feel the intense pain of having their stop losses triggered. They watch their hard-earned capital evaporate simply because they fell for a fake move. On the flip side, we have smart money. Smart money doesn't buy the fake breakout. Smart money waits patiently for seller confirmation.
So how do we trade like smart money? Section 4, executing the perfect trade.
All right, here is your step-by-step tactical playbook for this exact setup. Rule number 1, do not buy. Seriously, under no circumstances do you take a long position here. Rule number 2, you absolutely must wait for the lowest point of the inverted hammer to be broken by the current price action. This is your ultimate confirmation that the sellers are actually following through on their victory. And rule number 3, you enter the sell trade immediately upon that break, not a single second before. By waiting for that specific low to break, you completely bypass that agonizing fake upward retail trap we just talked about.
Okay, so you're in the trade. Now you need a systematic exit strategy. Here's how you set your profit targets. Step 1. Your first take profit target should be placed exactly at the lowest point of the previous hammer candle. That is the nearest significant support level, and logically, it's a battle line where buyers previously tried and failed to hold ground. Step 2. If momentum is strong and you're holding a runner, your second ultimate target becomes the lowest point established just prior to the hammer candle's formation. This just ensures you're locking in maximum gains at highly logical, proven battlefield levels.
But of course, as any focused learner knows, capital protection is just as vital as making a profit. For your stop-loss execution, you've got to place it safely above your selling entry price, ideally near the previous high established by the inverted hammer. The source stresses placing it just a tiny bit higher to ensure it doesn't get falsely triggered by normal, everyday market volatility. Basically, it needs to be placed at a level where, if the price actually reaches it, it mathematically proves our entire thesis about the sellers winning the battle was completely wrong, and we need to bail out immediately to protect our account.
Which brings us to our final part, Section 5, the ultimate takeaway on mastering this clash.
By now, you have a distinct edge. While 90% of traders freeze up when these contradictory candles clash, you now know exactly how to identify the winner, completely dodge that painful retail trap, and confidently ride the momentum downward. But I want to leave you with a provocative thought here. We just spent this explainer mastering what to do when the sellers win this battle, but what if the order is completely reversed? Think about it. What if an inverted hammer forms first, attempting to push the price down, and is immediately followed by a massive hammer candle? Who is the winner then? And exactly where is your buy trigger? Keep that rule of the winner deeply in mind as you look at your live charts this week. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you on the next one.